Hello guys, how do you do? Today I want to welcome you to another episode where we are going to look at another method of calculating depreciation expense called the revaluation method. Welcome to the world of accountants, and this channel is called Simplified Accounts Guru, where we get accounting concepts in a simplified manner. And my name is CPA OTIENO. So kindly feel welcome, and maybe you can also consider subscribing to this channel, like, share, and comment. And without wasting much time, allow me to go straight to the work that we have today so that at least we can get the bit of the revaluation method which we have for today. Now, in our lesson 8, we are going to look at depreciation part 2. And in this part 2, we want to look at other methods of calculating depreciation expense. You remember the other time when we were talking about the main approaches or the main methods of calculating depreciation, we talked about the straight line basis of calculating depreciation, and also we looked at the reducing balance method of calculating depreciation. So the third one that we are looking at today is called revaluation method. Now, under revaluation method, what we are saying is that when we have a few expensive non-current assets, it becomes very easy for us to come up with the necessary accounts for depreciation, since we can find the cost, useful life, estimated percentage of depreciation cost, etc., etc. However, it becomes very difficult when now we are talking about non-current assets of which the calculation of because they are of low cost. So if you want to dig deep into finding the cost, the useful life, estimated percentage of depreciation for each and every item, it becomes tiresome, and it wastes a lot of time. So because accountants, just like I had said in prior lessons, accountants do not really have much time to waste because we have a lot to do, and because we are striving each and every time to produce accounts that show a true and fair view of the financial position of each and every institution that we work for, then it becomes very difficult to concentrate on those the finer details, which I would call immaterial details. So therefore, we are given another approach that we can use in calculating depreciation expense, which is called the revaluation method. Why do we talk about revaluation method? You know, when somebody talks about revaluation method, it means that we are revaluing an asset which already had been given some value, or we are giving value as per the market rates. We are giving value, we are allocating some value for a product or an asset that had already been valued. It is an asset that had already been valued, but now we are trying to relook into the aspect of its value so that we can confirm that the value which had been given unto it is still commensurate to that particular asset or not. So if we realize that the value has gone up, we also go up in terms of giving the value to that particular asset. Or if the value has gone down based on different circumstances and reasons, then we are also forced to revalue downwards the cost of that asset. Some businesses may have very low cost non-current assets, meaning that the assets, their costs are very immaterial, and several of them are owned by the business and controlled. You remember how we had defined what an asset is. It is that resource that is controlled and owned by the business as a result of past economic events, from which future economic benefits are expected to flow to a given organization that owns it. So a garage would have a lot of spanners, screwdrivers, and other small tools. Laboratory would have many small low-cost lab apparatus, and brewers would also have some crates, and etc., etc. You can name them going forward. Now, We also have, within the circumstance, it may be difficult for the accountant to use other depreciation methods like the straight line method or even the reducing balance method of calculating depreciations. Hence, revaluation method becomes the best to do that, because for revaluation method, you just look at the asset in question and then you compare that asset in terms of the value, or rather the amount that it can be able to fetch for you if at all you would subject this particular asset to some sales. If you take it to the market, how much can it be able to fetch you? So that becomes the value of that asset. So the process of doing that is what we call revaluation process. That is what we call the revaluation. And by allocating the value to an asset using that kind of approach, that is what we call using the revaluation method to know the depreciation expense. And remember, we talked about the depreciation as the depreciation expense, which we said is the cost, or rather the value that is lost in an asset within over a given period of time when it is being used by the business. There is that bit, there is the value of that asset that is being lost year in, year out. So each and every particular financial period, we are supposed to determine the cost that is lost, or rather the value of that particular asset that is lost within the year, so that we account for it as part of the depreciation expense. So we have a business that starts its operations on 1st January 2013, and then these are the transactions that took place. So the business is starting on 1st January 2013, but then we are being given much more information pertaining to that business and maybe the particular asset that we are required to revalue its cost. So in this case, we are going to talk about an asset called crates. These crates are owned by a particular business. So for us to be able to know the depreciation expense that has been incurred by the business relating to the cost of crates, this is how we are going to go about it. Let me first of all take you through what we have. Number one, in its first year, it buys crates costing $800. Their estimated value as at 31st December 2013. That is, as at the end of that financial period. Remember, the business started on 1st January 2013. So as at the end of that financial period, we are being told that the cost of those crates have been revalued to $540. So that is what we use as the revalued cost. So we'll see how we can be able to get the balance so that we know what has happened in between, what has been lost, what is it that has been lost out of the cost that was due, the original cost of that particular asset. Then that becomes our depreciation expense. Now, then the third item is crates bought in the year ended 31st December 2014. Remember, that is another subsequent year after the 2013 year. So we are having an introduction of another financial period where we are being told that as at the end of that financial period, we are having crates bought in the year ended 31st December 2014. We have $320. That is the value of crates that were purchased in that particular period. So that is the additions. And then we also have estimated value of all crates in hand. As at 31st December 2014, we have $530. So that tells you, because you can see here it is indicated as estimated value. Remember, when I was explaining the revaluation method, I mentioned that we look at the price that the asset can be able to fetch for us in the business, if at all it can be sold out as at the period that is being talked about. Then we also look at the next statement, which is telling us that crates bought in the year ended 31st December 2015 amounted to $590. So that is also another purchase. Then, within the financial period, the estimated value or the market value of the crates that are pending or the crates that are owned and controlled by the businesses at that point in time amounted to $700. So now let us go direct to solving the question because we are asked to get the depreciation expense using revaluation method. So this is how we are going to get our solution. So we'll draw the T accounts. You remember we had talked about the T accounts. So we'll draw a T account which has got the debit and the credit side. So we have a T account for crates. We need to name it crates account. Remember that's an asset account. And then we also need to have the debit side. We also need to have the credit side as well, actually. And we also need to have the symbols of the currency that we are talking about. So up to that point, for us to be able to obey the double entry concept, we are supposed to have another T account which represents or which gives us where the other corresponding entry is going to be put or be passed. So this is the T account which we call the profit and loss account. Within the profit and loss account, we have got this depreciation expense. Within the profit and loss account, after you shall have calculated your gross profit, then you are supposed to add other incomes, then you less operational expenses. So within the operational expenses, we normally add something called the depreciation or amortization expense. Now, we have got the first instance of purchase. We were told that in its first year, it buys crates costing $800. So what do? When an asset increases in value, when an asset increases, what do? We debit the asset. So we are supposed to debit the crates account with the value $800. We already have the symbol of dollars there. So what we only need to do there is just to put the $800. So we need to put that one alongside, or rather with a corresponding entry. Remember, this profit and loss account that we have here is just going to show us the final bit, because we are much more interested in seeing how depreciation expense appears. What happens about that depreciation expense? So we are going to eliminate other bits, other T accounts like the cash account. Remember, when we are purchasing this asset, we are going to use either cash or we are going to have a creditors account. But for now, allow us to eliminate all that. Our major focus in this case is just the asset account and the depreciation expense account. That is why we only have two accounts. The company has bought crates costing $800. In this case, we are supposed to credit the cash book as we debit the crates account because the asset has gone up. Remember, the cash book, or rather the cash at hand or cash at bank that is being used is supposed to be credited because the bank is reducing or asset is reducing. So in this case, we are using two assets. We are reducing one asset to acquire another asset. That is what we are doing in short. So we debit by saying on 31st December 2013, cash at hand, meaning that if you go to the cash account, you are supposed to credit using credits account $800. And then their estimated value as at 31st December 2013 amounted to 540. So this is the closing balance. In other words, this is the closing balance. After revaluing the asset, after looking at the amount that this asset can be able to fetch us in the market, if at all it can be sold, then we came to realize that it can only give us $540 instead of $800. Now you can see there is a variation which talks about some loss in value, a reduction in value. That reduction in value is what we call the depreciation expense. So now we need to record on the credit side of the asset, we need to record the closing balance. So the closing balance for an asset, it appears on the credit side, and then the opening balance appears on the debit side. That is under normal circumstances. So now, if you want to know the difference, if you want to know the depreciation expense that has happened here or that has been incurred, then you are supposed to have the total cost of that particular asset, the original cost, minus the closing value. So in this case, first of all, you are supposed to know what is the total that you are having. Under T account here, you will have, we have these symbols here where we are going to record our totals. So we have the 800 there. We also have 800 there. And then now what you ask yourself, we are supposed to be having, we take 800, we take 800, this 800, you add nothing to it to give you 800, which means this side is balanced. How about this side? There is something pending here. There is something lacking here for it to come to $800. So you will take 800 minus 540 so that it gives you $260. So this is the value that you will take to depreciation expense account. And that depreciation expense account, we had said that it is the expense account, it is the depreciation expense that will be used for that particular financial period. So your net profit will go down by that amount. So we have to record that one. After having done everything that you are supposed to depict in the profit and loss account, then you will also have to show this bit. That's why I've given it similar colors. So you can see here, we have profit and loss account there. We have depreciation on crates. You can see the way I've described it. So this one is one financial period. Remember, once you have done that, the financial period ends at that point, and then what you only need to do is to take the closing balance to become our opening balance, like that. So it comes from here as the closing balance, and that is what we use to open a new financial period. We closed with $540. We are opening with another $540. Now the next question is, do we have another purchase? Do we have another deduction? So in this case, we are being told that crates in the year ended 31st December 2014 were bought. The company bought in the year 2014 crates amounting to $320. So that is what you need to add here. So you add here $320. And then what else? If you look at the other information, they are saying that estimated value of all crates in hand as at 31st December 2014 amounted to $530. So we had said that the closing balance for an asset account is supposed to be credited, while for the other, let me say, a liability or capital is supposed to be debited. So by default, we are going to credit the closing balance. So we have $530 there. Now we'll draw the lines that we have, put those symbols so that we can be able to obtain the totals. So the totals, what you do, you pick the higher of. You look at both sides and pick the higher of. That becomes our total, the balancing figure. So in this case, we'll be having 540 plus 320. Compared to 530, you realize 540 plus 320 gives us a higher figure than 530. So we'll use the balance, we'll use the total that is obtained from the debit side. What is that amount? It is 860. So that's what you use on both sides. Then, as we had said in the earlier circumstance, we mentioned that for you to be able to know the amount of depreciation for that particular financial period, you are supposed to take the total or the balancing figure, which is 860, deduct the closing balance so that you can know the amount that has been lost by the organization in regard to the crates. So in this case, it will be 860 minus 530, which will give us $330. So this is the cost that has been lost within the financial period. So the cost that has been lost becomes the depreciation. So this depreciation expense that we are so much interested in the financial period ending 31st December 2014, we shall record the same amount in the profit and loss account. Remember, the first instance that we had, the depreciation expense which we had in 2013, will not be shown again in the financial period ending 2014 in the profit and loss account. We have another operation that took place in the year ending 31st December 2015. Credits bought in the year amounted to 590. So now, because we have another transaction which happened in another financial period, what I would recommend, we use the closing balance in the prior financial period to open the subsequent financial period. So we are going to have on 1st January 2015, the balance brought down in regard to credits is amounting to 530. The 530 we are taking it from here. We are picking it from here, which is the closing balance. Then you use it as the balance brought down. Balance brought down is equivalent to balance carried down from a prior period. Now, we said that once you have the opening balance, what you need to look at, or whatever you need to look for, is the additions and the subtractions within the financial period. So in this case, the additions will be the credits purchased. Do we have any credits purchased within that financial period? Yes, we do. Now, in this financial period, we are being told that credits bought in the year ended 31st December 2015 amounted to $590. So that is what you bring in here. Remember, we had mentioned that as you bring in this one, remember there is another corresponding entry which you are supposed to make in the cash book on the credit side so that you reduce the amount of cash that you have. The estimated value of all credits as at 31st December 2015 amounted to $700. We said the closing figure is being credited. The closing balance in an asset is being credited under normal circumstances. Now, we'll use that one on the credit hand side so that we have 700 and we have 530 plus 590. If you put the symbol of getting the totals here, then you'll realize that the side of 530, the side of 530 and 590 should be greater than the side of 700. So we get the totals here. We use the total of the higher side, which is $1,120. That is the same amount that you use on this other side of 700. Then, for us to be able to know, just like we had done in the prior cases, for us to be able to know the amount which we need to use as the depreciation expense, you pick the total, which is 1,120 minus $700, so that you can know the amount that has been lost within the financial period. So that tells you we have 420. 420 is the amount that has been lost in the financial period. That becomes the depreciation expense incurred within the financial period ended 31st December 2015. So that is what you will be expected to show in the profit and loss account as you finalize for you to be able to get your net profit. Then finally, because we have to start another financial period, we can use the closing balance, which is $700, to open another financial period just in case there would be any other transaction in the future. So we just pick 700. So we put there $700 to be our balance brought down. That is balance brought down on 1st January 2016. I beg your pardon. So we are moving, and up to that point, I believe the revaluation method is well understood by each and every student who had been listening to this lesson. For those who have joined today, kindly do not go away without subscribing to this channel for you to be able to support this channel. And for the subscribers who are returning for another round, I say thank you. I respect you so much. Please let us proceed with the journey. I know we are going to get much better concepts of accounting. Thank you so much. My name is CPA OTIENO. Until another time, thank you.